Hello friends, I am dividing this direct tax amendment lecture for May 2016 students into two parts. So in the first part and slide I will be covering the slabs, the residential status plus section 9 related amendments, profits and gains from business and profession, income computation disclosure standards, range concept relating to transfer pricing and TDS. So this is what we will get in my first slide, approximately 1 hour 10 minutes. In the other one more which will come at a later point in time, which will be covering capital gains, MAT, assessment procedure, SETCOM and other miscellaneous provisions if any. Thank you so much. Good morning friends. First of all, thanks a lot for a very good response to the OR lecture that I had taken, and taken very positively by the students and helping a lot of them. So going ahead with that trend, now direct tax is the paper that you are going to appear for. So today's lecture will be on the amendments made by Finance Act 2015, because that is what will be applicable to May 2016 students. Again, I will be covering the major amendments, the important ones from the exam perspective, and the base that I have taken is the supplementary study material that is issued by ICAI in order to ensure that we are at the same sync with what ICAI is planning to ask. So again, focus on the major amendments. Not all the amendments are going to be covered, and second, we will not go very much in depth as to the history and everything. We will just focus on what the amendment is trying to say and how it will be linked in terms of exam perspective. Alright, so now always start with the basics. I am sure majority of you all know what exactly the basic tax rates are for Finance Act 2015, but we will always start with that. So start with slabs for individual, HUF, AOP, BOI, artificial juridical person. We all know that up to 2,50,000 the tax that they have to pay is nil. The moment income increases beyond 2.5 lakhs up to 5 lakhs, it will be 10%. Beyond 5 lakh up to 10 lakhs it will be 25,000, which is a part of this, plus 20% on income exceeding 5 lakhs, and greater than 10 lakhs is 1,25,000, which is a part of this, plus 30% on income exceeding 10 lakhs. Then comes resident senior citizen. The word is resident senior citizen. Who is a senior citizen? Beyond age 60. So again, the word that used is resident. So non-resident senior citizen will still fall probably in this category, but resident senior citizen will get a higher benefit of up to 50,000. So up to 3 lakh he doesn't have to pay any tax. Beyond 3 lakh up to 5 lakh 10%. Beyond 5 lakh to 10 lakh 20,000, which is a part of this, plus 20% on income exceeding 5 lakh. Beyond 10 lakh 1,20,000, which is a total of this, plus 30% on income above 10 lakh. As I said, I am sure majority of you all know this. Third thing, resident super senior citizen beyond the age 80. Again, word used is resident super senior citizen, up to 5 lakh nil. So again, an extended benefit of 2 lakh over the resident senior citizen. 5 lakh to 10 lakh 20%, 10 lakh beyond it will be 1 lakh plus 30% on income exceeding 10 lakhs, which is a part of this. So this is how the tax slabs are for individual, HUF, AOP, BOI, AJP. The individual less than 60 years of age, HUF, AOP, BOI, AJP all fall in this category. Individual resident senior citizens will fall in this category beyond 60 years of age up to 80. Resident super senior citizen beyond 80 years of age will fall in this category. There is a surcharge which is applicable for persons earning a very high level of income. So surcharge at the rate 12% of tax. Again, surcharge is calculated on the tax amount. I am sure as students you might know that, but exam mein likhte waqt there is a lot of tension and pressure. At times students do this mistake, they take 12% of the income. Surcharge is calculated on the tax, not on the income. So surcharge at the rate 12% of the total tax only if my net taxable income is greater than 1 crore. If it is less than or equal to 1 crore, then in that case no surcharge is applicable for any of this. So surcharge at the rate 12% of tax if net taxable income exceeds 1 crore. Post that, add education cess. Now this education cess is common to all persons as defined by section 2. So education cess will be at the rate 3% of tax plus surcharge. So you have a tax amount, on that tax amount you calculate your surcharge. Total of tax plus surcharge is what we will take to calculate 3%. There is a bifurcation of 2% and 1%. We will just take the totality. 3% of total tax plus surcharge will be your education cess. This education cess is common, 3% for all the entities for whatever tax plus surcharge that they are going to pay. Something that I am not going to repeat again. Moving on to other entities, companies. Companies divided into two parts, domestic company and foreign company. For domestic company, flat rate 30% of net taxable income. Foreign company, flat rate 40% of net taxable income. Change here, amendment here is in surcharge. Because Shri Arun Jaitley has removed the wealth tax, obviously there has to be some compensation that has to become and that obviously will be through this 2% increase in surcharge. So 1 crore to 10 crore, 5% was the surcharge, now increased to 7%. Be above 10 crores, 10% increased to 12%. Again we see here, first previously it was 10%, now increased to 12%. So there is a 2% increase in surcharge as can be seen on result of abolition of wealth tax. So 1 crore to 10 crore, 7% surcharge, beyond 10 crore 12% surcharge. No changes in surcharge rate for foreign company, up to 1 crore nil, 1 crore to 10 crore 2%, beyond 10 crores it is 5%. Firms, LLP, local authorities 30% flat tax rate, surcharge at the rate 12% of tax if net taxable income exceeds 1 crore. For cooperative society, there is a different slab structure that they have to follow. Cooperative society, section 80P. So here up to 10,000. See again, I am using some short forms, 10K, 20K, 20K. That K represents thousands. Obviously, do not use this in the examinations. This is a quick reference revision lecture going on, so please pardon me for that. Up to 10,000, 10% of total income. So for cooperative society, the taxable amount up to 10,000, 10% of total income. 10,000 to 20,000, 1,000 plus 20% on income beyond 10,000, and about 20,000, 3,000, which is a coverage of this, plus 30% on income greater than 20,000. So that clears off the basic as far as rates of various persons are concerned. Now we start with the hardcore amendments that have come in through Finance Act 2015. Alright, moving on with the first amendment, section 6, subsection 1. There is an explanation added by CBDT. Explanation pertains to citizen of India going as a member of crew. So now what happens is there is an exception which says that if you are a crew member of a ship, then in that case only basic condition 1 will be applicable to you. But a practical difficulty that has been faced is how to determine the duration of days when he is in India and when he is outside India, because the ship will be in no man's land at a time, will be in India for some time, will again stay in India for some duration, go out of India. Determination of duration becomes very difficult, and as a result, to remove this ambiguity, CBDT has introduced a mechanism to determine how to find out the number of days. So there is something called as a continuous discharge certificate which will be issued to the employee, and this continuous discharge certificate will determine the duration of days for which the particular citizen of India is outside India, even though there will be certain days which are mentioned in this CDC for which he is in India, but this CDC will be the determining factor. What am I trying to say? Pay attention. Suppose there is a ship which leaves from Mumbai port on a particular day, say for example 1st September 2015, and it goes, say for example, to West Bengal port, which is still a part of India, on say 5th of September 2015, then leaves India and say goes to South Africa, and then comes back to West Bengal, and then comes back to Mumbai. So say for example it leaves again back from South Africa on 10th Jan 2016, comes to West Bengal on 15th Jan 2016, just a hypothetical example, and comes back to the Mumbai port on 25th Jan 2016. So the continuous discharge certificate will be from 1st September 2015 to 25th Jan 2016. Now if you see here, the ship, or for that matter that particular citizen of India, was still in India even on 5th September 2015, but CDC mentions that date to this date, and that will be considered as outside India. So this will be the determining factor. The continuous discharge certificate will be the determining factor to ensure that whether the citizen is outside India or whether he is in India. Even though, as I said, practically he may still be in India even in this period, but that is not to be considered. The real consideration will be continuous discharge certificate. This is applicable only for the eligible voyage. So eligible voyage is when a voyage will leave outside India and then the other voyage will come back to India. So it will be applicable only for that. So continuous discharge certificate, section 6 subsection 1 explanation 2, added by Finance Act 2015, which says that this CDC will be the determining factor to consider whether a citizen, what is the duration for which the citizen is outside India. So when this citizen will calculate his residential status for a previous year 15-16, he will calculate this duration, and for this duration he will say that he is outside India. So 366 minus the duration of continuous discharge certificate and the remainder days is what he will be considered as in India, and accordingly his residential status will be calculated. Section 6 subsection 1 explanation 2, the same point is also covered by your RTP, so very important. Moving on, section 6 subsection 3 has amendment through Finance Act 2015, residential status of a company. Again, I am using short forms, do not use that in your examinations. I have a different perspective and motto, hope you understand that. So residential status of a company. Now prior to Finance Act 2015, there was a loophole. So what was the loophole? So there is a domestic company, there is a say non-domestic company or a foreign company. This foreign company will be considered as a domestic company only if its management, control and management is wholly in India. If this is the scenario, then this foreign company, non-domestic company, will be considered as a domestic company, and accordingly it will be charged to taxation. Obviously a domestic company is chargeable to a lot more incomes than what non-domestic company will be. So what these company used to do is just hold one board meeting outside India and say that the control and management is not wholly in India. If it is not wholly in India, then in that case it will remain to be a foreign company, even though control and management effectively 90 to 95% is still in India, right? So in order to remove this loophole, Finance Act 2015 amended section 6 subsection 3, and the whole determination of residential status of company is now dependent on POEM, which is called as the place of effective management. Well, this is a step towards moving for international regime, because a lot of OECD countries also accept POEM as a tiebreaker to determine whether residential status of a company is resident or non-resident. What is POEM? It is called as place of effective management. So what is place of effective management? Place where key commercial decisions of business are taken. So key commercial decisions of business are taken. Here in such a scenario where just one board meeting is held outside India, whereas all others are held in India, I will say that yes, key commercial decisions are taken in India. Accordingly, the place of effective management in this scenario is India, because key commercial decisions are being taken in India. So let's draw this in the form of a flowchart as we have in the supplementary. Is the company an Indian company? If the answer is yes, wow, no need to move on. If the answer is no, if it is not an Indian company, that means it is a non-domestic company, a foreign company, then in that case we will see what is its place of effective management, POEM, place of effective management, where key managerial and commercial decisions of the company are made. Here holy word was used previously prior to Finance Act 2015, as a result of which sham companies were created outside India, even though controlled from India. Now that is not possible, because we check the place of effective management, place where key managerial and commercial decisions are being made. So here this determines whether, so if POEM in India, then in that case, even though you are a non-Indian company, you will be considered as a Indian company resident in India. I hope we are clear with the provision. Section 6, subsection 3, place of effective management is the determining factor to determine whether a company is resident in India or not. Section 9, subsection 1, clause 5. Taxability of interest payment to a non-resident, being a person engaged in business of banking by its P in India. Business of banking by its P in India. Again, non-resident P engaged in banking business. So keep that thing in mind. Now what happens, or what happened was, suppose there are a lot of multinational companies which have come into India, including those having banking businesses. So here let's take this example. City India, having say a banking establishment in India, takes a loan from its head office which is in USA. So City USA takes loan, and it also takes a loan from City Malaysia, which also has its establishment, permanent establishment in Malaysia. So City India takes loan from City USA head office, or City Malaysia, another permanent establishment in another country. Now if this P is taking a loan, now again the main company is City. So here if they are taking a loan, Indian company will pay interest to them, which so far was considered as payment internally, no income accruing to anybody, no expense allowed to anybody. Now with amendment in FA 2015, section 9 subsection 1 clause 5, it says that this payment of interest by City India, to USA and Malaysia respectively will be considered as income deemed to accrue or arise in India for City Malaysia and for City USA liable to tax, and accordingly the P in India has to deduct TDS on payment of interest, to its respective permanent establishment. So as I said, previously considered as payment to self, so no tax impact, but now with amendment the City PE India has to deduct TDS. If it does not, then in that case this payment of interest will be, the expenditure will be disallowed, and plus there will be levy of interest and penalty for non-deduction and payment of TDS on interest. So this is how the amendment works for section 9 subsection 1 clause 5. Now collateral damage, or should I say collateral amendment to the Vodafone case. I think Finance Act 2012 inserted an explanation 5 to section 9 subsection 1 clause 1, which speaks of income deemed to accrue or arise in India, that in cases of foreign companies which derive their value of assets substantially from India, in such cases those foreign company shares when transferred will be considered as income deemed to accrue or arise in India. What am I trying to say? Pay attention. Now you will understand. Value of Indian assets to determine whether share or interest of a foreign company or entity is deemed to derive its value substantially from assets located in India. From the heading, we do not understand anything. Alright. Hold on. What does section 9 say? Section 9 says that any business connection in India, property in India, asset or source of income in India, transfer of capital assets situated in India, this is where now I will link things to, will be considered as deemed to accrue or arising in India. Finance Act 2012, Shome Committee, Parthasarthi, Shom, they introduced this explanation 5, which stands as under. Pay attention, we will try and understand it with an example. Suppose this is a balance sheet of an Indian company. Obviously, Indian company balance sheet will have Indian assets and its shares. These shares are held as investment by a foreign company. Are we understanding the connection? So there is a Indian company which has Indian assets. Obviously, these Indian assets are held by the shareholders. These shares are held as investment by this foreign company who has foreign company as their shares. So can I say this foreign company is deriving majority of its income through Indian assets? Right? This foreign company, what asset does this foreign company have? It has assets as investment in Indian company shares. These shares obviously have majority of their assets as Indian assets. So this Indian company will earn money, will earn profits, transfer it as dividend to the shareholders of this foreign company which is holding this share as an investment. This income will be again transferred to the foreign company. I hope we are understanding the connect. So value of Indian assets. Now get the connect, explanation 5. Value of Indian assets to determine whether share or interest of a foreign company, or entity is deemed to derive. This company is deriving its value substantially from assets located in India. Explanation 5 says, in such cases, when this foreign company shares are transferred, it will be considered to deem to accrue or arise in India. Why? Because value of this foreign company shares are directly, indirectly deemed and coming from the Indian assets, transfer of capital assets situated in India, asset source of income in India. I hope explanation 5 is clear. Now, amendment is for explanation 6 inserted and explanation 7 inserted. The word substantial was not defined, which is now defined by explanation 6. What is substantial? So here you say that yes, Indian assets, the foreign company is deriving its value substantially from assets located in India. What is substantially is given by explanation 6. Pay attention. This substantially means that this value of Indian assets should be greater than 10 crores. So this should be more than 10 crores. And that should also represent at least 50% of value of all assets owned by the company. Assume that there are some other assets owned as well. So this investment in Indian company shares, say this is 25 crores. So point number 1 satisfied substantially. Second, here let's say other foreign assets by this company is say 10 crores. Total works out to 35 crores. Now this value of Indian assets, which is 25 crores, should represent at least 50% of value of all assets owned by the company. 50% of 35 crores is 17.5 crore. Is this 25 crore more than that? Yes, sir. Is this 25 crore more than 10 crore? Yes, sir. Both conditions satisfy. Explanation 6 is invoked, and we will say that yes, substantially this foreign company is deriving its value from the Indian assets, and through explanation 5, any sale will be, any transfer will be deemed to accrue or arise in India. Explanation 7 has been inserted for minority shareholders. What if this foreign company shares, yes, is deriving majority of its thing from the Indian assets, but if there are some shareholders, some foreign shareholders who hold just 10 shares in the company of say 1 lakh shares. Say there are 1 lakh shares here, one shareholders hold only 10 shares in the company. Will that person be liable? In that case, explanation 7 is invoked, and which says that if in 12 months previous to transfer, so if this small shareholder is transferring his shares, in that case we will see before 12 months from the date of transfer whether he has any right of control and management. If answer is no, then he is saved. Or, so either of the conditions have to be satisfied. This is plus, so both of the conditions were to be satisfied here. Or voting power or interest or shareholding is less than 5%. So again, if this is less than 5%, then in that case this transferor will not be liable to any capital gain tax in India. If, however, just assume that he holds more than 5%, say he holds 20% of shares in India, then in that case 20% shares in this foreign company, then in that case he may not have a right to control and management, but he has a voting power interest shareholding greater than 5%, then his income will be deemed to accrue or arise in India, but on a pro rata basis. What is this pro rata basis? Pay attention here. In such cases, whatever is the amount of income that he will earn, that will be prorated to the Indian assets. So here total assets are 35, of which Indian assets are 25. Only this proportion is what he will be liable to tax for. In case this condition is violated, so he has voting power or interest or shareholding greater than 5%, then yes, he is liable to income in India on a pro rata basis. This pro rata basis will be determined for the share of Indian assets in the total assets held by the foreign company. A little complicated, but then CA final is what you are studying. Third point, so we are covering 3 points here. This foreign company, if declares any dividend outside India, then that dividend will be exempt as it will not be deemed to accrue or arise in India. A welcome move for the foreign investors, basically having foreign shares outside India. So yes, dividend will not be liable to any tax, but transfer of shares will be liable to tax if value of Indian assets are substantially, value of foreign shares are substantially from Indian assets. What is substantially? The value of Indian assets should be more than 10 crores plus they should represent more than 50% of the value of all assets owned by the company. And if that is there, then we will see explanation 7 in case of transfer of shares, which says that if there was no right of management and control or voting power shareholding was less than 5%, then that particular shareholder can be saved from clutches of tax, else he will have to pay tax, that too on pro rata basis for the amount of income which is derived from the Indian assets, which will be calculated on a pro rata basis. Section 911, explanation 5, 6, 7 and the dividend point introduced by FA 2015. Profits and gains from business and profession. Depreciation is an aspect which is quite a lot asked by the institute in the internal sums that they have. So 3 major amendments that we can see in the depreciation aspect. First is relating to the additional depreciation. So additional depreciation, we all know, available to manufacturing industries for new plant and machinery at the rate 20% only for the first year. Now when I say this only for the first year, there was some ambiguity as to if through a proviso I purchase the asset which is less than 180 days, which I use for less than 180 days. So use less than 180 days. In such cases, 50% depreciation is provided and the other part is then taken forward. This I am talking of is the normal depreciation. So normal depreciation 50% is in the current year. The remaining depreciation still you can take for the remaining life of the asset. As far as additional depreciation is concerned, it is allowable only in the first year. So what if somebody purchases the asset and uses it for less than 180 days during the previous year? He will take additional depreciation at the rate 50%. So 10% is the additional depreciation he will get. What for the remaining 50% depreciation? This is now cleared by Amendment Finance Act 2015, which say that this balance 50% of additional depreciation can be taken in the next year as well. So in totality 10%, this 50% remaining, balance 50% in the next year, total 20% is what it works out to be. Otherwise what people would do is people will postpone the purchase of their machinery, because then they will lose out on the 10% of additional depreciation, which may have a big impact on their tax outflow. So accordingly, this is a welcome change for the manufacturing industries, wherein if you purchase plant and machinery which is used for less than 180 days, then 50% additional depreciation in the current year and balance 50% in the next year will be available. Moving on, section 32 AD speaks of manufacturing industries again, but this time to the backward areas as per the income tax department, the backward areas of Andhra Pradesh, Bihar, Telangana and West Bengal. These are the states which are considered as backward districts for provisions of section 32 AD, which says that if there is a company SSE in Andhra Pradesh, Bihar, Telangana or West Bengal, and they are setting up they are having a new setup, then in that case they will get an additional allowance of 15% of actual cost for the investment in machinery, which will be over and above section 32 AC, which is already providing some additional benefits. So section 32 AD for company SSEs located in Andhra Pradesh, Bihar, Telangana, West Bengal, they are newly setting up industry and purchasing new plant and machinery. So 15% of the actual cost is an additional benefit that they are going to get through section 32 AD, which will be over and above section 32 AC, which will be over and above section 32 subsection 1, which is depreciation, which will over and above be above section 32 subsection 1 clause 2A, which speaks of additional depreciation. So Andhra Pradesh, Bihar, Telangana, West Bengal. Again, plant and machinery, new plant and machinery, same definition as provided in 32 AC or in the case of additional depreciation. So no second hand, no ships and aircraft, etc. Additional depreciation will also be given to the backward, to the company set up in backward areas as given by section 32 AD. The additional depreciation will be 15%. So they have written is 35%. What is this 35%? 20%, so any which case everybody is going to get. What is the benefit that these backward areas will get? They will get additionally 15% additional depreciation over and above the 20% normal additional depreciation which every other assessee in the manufacturing industry is going to get. Again, a welcome change for Andhra Pradesh, Bihar, Telangana, West Bengal, who are setting up their new industries and purchasing plant and machinery. Same concept will apply here. If it is used for less than 180 days, then this additional depreciation of 35%, again in the current year 50%, in the balance in the next year. So this is the three amendments which have been brought to Finance Act 2015. So 32(1)(2)(a), balance 50% additional depreciation. 32 AD, company assessee states of Andhra Pradesh, Bihar, Telangana, West Bengal, 15% of actual cost over and above the other benefits that the assessee is already getting, and additional depreciation at the rate 35%, 20%, in which case every assessee gets additional 50% for these backward areas through section 32 AD. Alright, now come to Income Computation Disclosure Standards, ICDS, something that May 2016 students are really concerned about. Not really, ICDS, I don't see majority of questions coming from this chapter, because still we are yet to embrace it in a very proper manner. This is more like your Ind AS. You had hardly 5-mark question asked. Same way ICDS, there can be a question or two, but that will be on some fixed concepts. Question number 1 in your RTP speaks of ICDS. We'll talk about that. Supplementary study paper speaks of other 3 ICDS in terms of 2 in terms of linkage with provisions and some conflicts, and 1 speaks of the case law. So we will cover all of that is covered by supplementary study paper in terms of the concept that will hit the sections directly or case laws, and then we will check out how it looks. Income computation disclosure standards used with effect from 1st for 2015. So 31st March 2015 is when it was decided that we are going to adopt ICDS, and 1 for 2015 was the date to start with. Used only if your books of accounts are mercantile system and for heads of income, profits and gains, business and profession, and income from other sources. So only these are the 2 heads of income for which ICDS are made applicable as of now. So there are 10 ICDS which have been notified as on 1/4/15, which we have to look into. Again, I am personally going to focus only on 4 which I feel are important. First is ICDS 7 relating to government grants. Very, very important. What are ICDS? Accounts has their accounting standards, audit has their standards on auditing, tax will now have its own tax standards. So basically this is your tax standards which you will have to follow. Not that this has been introduced for the first time. We used to have just 2 tax standards we used to have, but then now is when we are planning to take it to a very extensive level, and that is where 10 have been notified and some few are already in pipeline. So ICDS 7 speaks of government grants. Your link with AS is AS 12, which speaks of government grants. So what is government grants? Any subsidy, any grant, cash incentive, duty drawback, waiver, concession, or any other name called in such manner will be your government grants. Now, prior to Finance Act 2015, there are a lot of case laws associated with this concept of government grants. You open any last 3, 4 or more than that select case law book by ICAI, and the first page will always have whether the grant received by a particular assessee is revenue in nature or capital in nature, whether it will fall in any of the case laws which have been decided by Supreme Courts. Now a lot more clarity is being given by introduction of a new section and this ICDS being more clear of how to treat the government grants. Pay attention. Excuse me. So prior to Finance Act 2000 sorry, excuse me. So prior to Finance Act 2015, landmark case law of CIT versus Ponni Sugar Mills, Supreme Court decision of I think 2008. Now what is the object of subsidy or assistance was to be seen. Whether it is for your day-to-day business, running day-to-day business, then in that case it was treated as revenue government grant, income. Else, if it is for setting up new unit or expansion, then it was treated as a capital grant, as in case of CIT versus Rasoi Limited. Kisan Sahakari Bank Sahakari Limited was also one of the case wherein this point is elaborated. So government grants prior to Finance Act 2015 were classified based on the object of subsidy or assistance, whether it was for running day-to-day business, in which case it is revenue, or whether it was for setting up the unit or expansion, in which case it was treated as capital. Now with Finance Act 2015, the government grants are now classified as whether it is in relation to depreciable fixed asset or it is in relation to non-depreciable fixed asset. If it is in relation to a non-depreciable fixed asset, then it is recognized as income under section 2 clause 24 subclause 18, which has been specifically added through Finance Act 2015 with the introduction of ICDS 7 government grants. So now two things is what you have to see, whether the government grant for depreciable asset, for non-depreciable asset. For depreciable asset, in that case, reduce from actual cost or WDV. Explanation sec 10 to section 43 subsection 1 is what this will be. So there, in that case, if you are getting government grant in relation to this, reduce it from the actual cost or WDV. Or if it is in relation to a non-depreciable fixed asset, then in that case recognize it as income under section 2 clause 2418. So I think fixed asset, reduce from the cost of fixed asset. Simple. Anything other than that, put it as income, section 2 clause 2418. RTP question number 1 is what this speaks of. So they have asked that CIT Ponni sugar mills, in which they are trying to bifurcate on this basis, is that still valid post 1/4/2015? Now post 1/4/15 ICDS 7 and section 2 clause 2418 take it over, and this is how the bifurcation looks like. Moving on to the other, then is ICDS 9 borrowing cost. Again, they are more extensive. I am just focusing on the amendment related part as far as the sections are concerned. So there is a section 36 subsection 1 clause 3 which speaks of interest on borrowed capital. So borrowing cost, your AS 16, which again borrowing cost directly attributable to acquisition, construction or production of a qualifying asset. Can be building, machinery, all of those assets. Capitalize interest from date of purchase of asset to the date of put to use of the asset. This is what ICDS says. No problem there, but section 36 subsection 1(3) said that it will be capitalized, the interest will be capitalized from this date to this date only if the acquisition of asset was for extension of business. Now the word extension of business has been deleted. So even if acquisition of asset not for existing business or profession or expanding business or profession, even in that case section 36 subsection 1(3) will now say that capitalize interest from date of purchase of asset to date of put to use, even if the asset is particularly purchased not for expansion purposes. Moving on to ICDS 4 revenue recognition. There again connection is with 36(1)(7) which speaks of bad debts. Friends, you would all know that bad debts is an allowable expenditure if it is written off in the books of accounts. Bad debts allowable expenditure through section 36(1)(7) if it is written off. Actually it should be written off in the books of accounts, no other conditions required. Now revenue recognition for ICDS 4 and revenue recognition as per AS 9 have some conflicts. Certain income, say AS 9 does not recognize as income, whereas ICDS considers it as income and the assessee is liable to pay tax on that. So pay attention, revenue recognition as per AS 9, no income. I'm just simplifying it. ICDS considers that income and asks the assessee to pay tax on that. Now this is considered, say, accrued income, and in future there is a bad debt relating to this income on which we have already paid tax. There is a bad debt, we are not going to get this income. AS 9 any which case did not recognize it, but through ICDS we have paid tax, we have recognized that as income. Now we are not going to get it. Now section 36(1)(7) says that write off the bad debt and claim it as a deductible expenditure. How do I write it off in my books of accounts? Write off bad debts in books of accounts. How do I write it off in books of accounts when I have not recognized it at all? Right, so first I will credit some income related to that bad debt, then only I can debit that bad debt, that now it is not receivable because books of accounts have not recognized it as yet. In such case 36(1)(7) through ICDS 4 has been amended, which says that in case income has been considered through ICDS 4, then it will be deemed that it is written off in books of accounts and bad debts will be allowed to the assessee. So that is a major thing. So ICDS 4 now empowers that you can write off through even if you are not writing it off actually in books of account, because you have not recorded it as income. Just reading the context, where the amount of such debt or part thereof has been taken into account in computing the income of the assessee on the basis of ICDS without recording the same in the account. So ICDS may consider income without recording it in the books of accounts. Then in that case, if such income becomes irrecoverable, we have this extra benefit that even without writing off, we can still get the write-off benefit through 36(1)(7). Moving on, through a case law, which is ICDS 2, valuation of inventory, and there is again accounting standard 2 as well for valuation of inventory. We all know the landmark case laws of Shakti Trading and Ala Firm. Shakti Trading says valuation of inventory on date of dissolution of a firm where business is then continued by the partner. There the valuation of inventory will be cost or market value, whichever is lower. This case law has now been repealed, and the ICDS 2 says that valuation of inventory in all cases will be at NRV whether business is discontinued or not. So here cost or market value, whichever is lower, as by Shakti Trading, as pronounced by Shakti Trading through Supreme Court decision, no more exists, because now ICDS 2 says that valuation of inventory in either case will be at net realizable value. So ICDS 2, 7, 9 and 4, these are the 4 important ones through some sections or case laws connecting you. Last in line for PGBP is section 40A, I40A1, which says that there is a clarification given in that case. We all know that relates to payment of expenditure in relation to non-resident assessees. So there interest, royalty, fees for technical services or any other sum chargeable to service tax. So if you are not deducting TDS on payment of interest, royalty, FCS or any other sum chargeable to tax for payment to non-resident or foreign company, then it will be disallowed for non-deduction of TDS. What will be disallowed? The expenditure. But that expenditure will be disallowed, or for that matter, you have to deduct TDS only if that any other sum is actually chargeable to tax to that non-resident or foreign company. So if this non-resident or foreign company is receiving some income, obviously that is an expenditure to you. This expenditure will not be liable to TDS if the non-resident or foreign company which is receiving it as an income is not liable to pay tax on that particular income. No point of deducting TDS, and you will still get fully allowable expenditure as the clarification given by section 40A1. So this wraps up business profession. A new concept relating to transfer pricing. So transfer pricing, taxation of non-residents will form a very, very important aspect of your examinations, to do it very, very thoroughly. So now the concept is of range. So the new concept is called as range concept. Refer your RTP and you will find this range concept, although they have not explained it that convincingly in the RTP. So let's have it with the help of an example. Should look good once we are done. Just try and understand steps, ensure that numerically you are doing right things, and the range concept should look good. So if you have to determine the transfer price. So for determining the transfer price, ALP is to be considered, which is your arm's length price, which is nothing but a fair market value if the transaction was not between the associated enterprises. So basically transfer pricing comes into the picture when there are associated enterprises. If it was not there, then the fair market value is what generally can be understood as your arm's length price. Now in order to determine your arm's length price, there are 5 methods. So whichever is the most appropriate method, MAM, most appropriate method will be considered. You have cup, comparable uncontrolled price, resale price, retail price method, cost plus method, profit split method, transactional net margin method. So either of it or anything else which suits the requirement of your transactions, called as the most appropriate method, you will determine the transfer price, the arm's length price, and then we will see whether it works or not. So if there is one arm's length price, not a problem, but if there are more than one price through most appropriate methods, then in such cases we take the average arithmetic mean of all such prices which are there. Then there is a tolerance band of 3%. So एक तो actual transaction price that I have done my transaction at with my associated enterprise, and the other is the arm's length price, which can be determined through various methods. So there can be multiple ALPs or one ALP, as the case may be. We will compare. Comparison allows a tolerance band of 3%. So if there is a deviation of 3% still allowed, you can take your actual transaction price. If it exceeds, then in that case probably there will be addition to your income. How does that work? So a simple example, actual transaction price at which I do my transaction with my associated enterprise is 180. ALP as per most appropriate method works out to 170, 188, 192. I will take a arithmetic mean average of all three, which works out to 183.3. As I said, I have a tolerance band of 3%. So what is my actual transaction price? It is 180. I have a tolerance band of 3%. So 180 into 3% is 5.4. So a deviation of 5.4 is still allowed with the average ALP. And if you can see here, 180, is this more than or less than 185.4? The answer is it is less than 185.4. So it is within the tolerance band. So I will say that it is within the tolerance band, and hence my transaction price will be considered appropriate. Alright. Now this is the scenario when there are less than 6 data sets. What do you mean by data sets? When there are less than 6 arm's length prices determined. If there are 6 or more data set through arm's length prices, then comes the concept of range concept. So 6 or more ALPs in the data set, and you take the use of range concept. Rule 10CA is what determines that. How do you calculate that? Suppose there are 6 or more data set through ALP through various methods, and if you see here, my actual price is 170. But ALP through various methods works out to A, B, C, D, E, F, G, H. So there are 8 ALPs possible through various most appropriate methods. How do now I get it? Because this is possible only if it was 5 or less. When we move to 6 or more, we have the range concept. So the first thing that you have to do is arrange all of the data set in ascending order. So arrange data set in ascending order. Arrange data set in ascending order. So 168, 175, 132, 142, 160, 180, 155, 165, all of them arranged in the ascending order. Once this is arranged in the ascending order, we will then see here, arrange in ascending order. Once that is done, so chote se bada is what we will do, ascending order. Then we have to calculate a 35 percentile and a 65 percentile. So what is this 35 percentile, 65 percentile? I'll tell you. There are total, what are the total number of values that we have? The answer is 8. Total number of values that we have, the answer is 8. Find a 35 percentile of that. What are the total number of values that we have? 8. Find a 65 percentile of that. So 8 into 35 by 100 will give you 2.8. 8 into 65 by 100 will give you 5.2. Now you have to check two things. Whether it is a whole number or it is a fraction. Tell me whether this is a whole number or a fraction. This is a fraction. Whether this is a whole number or a fraction, this is a fraction. In case there is a fraction, then select the next whole number. So 2.8, what is the next? 3. 5.2, next is 6. Don't see 5.5 ke upar, 5.5 ke niche. No. Even if this is 2.01, we'll still take 3. Even if this is 5.01, we'll still take this as 6. Now what do? Select the third value from this ascending order that you have. That will be 155. Select the sixth number from this ascending order. So 1, 2, 3, 4, 5, 6. 168 is what you have. Can I say that this becomes my ALP range from 3rd to 6th, which is 155 to 168. Is my actual transaction price between 155 to 168? Answer is no, it is 170. Then what do? Then in such case you have to find a median of the data set. So if actual price in range, then your actual price will become your ALP. If no, then ALP is equal to your median of the data set. What is the median of the data set? In our case, 8 values into 50 by 100, which works out to 4. If this was not 4, say it was 9, then in that case 9 into 50 by 100 works out to 4.5. 4.5 will not consider, will consider 5, the next best whole number. So next whole number. So here 8 into 50 by 100, 4, we will immediately go to 1, 2, 3, 4, and this will be my final ALP, and 160 is the answer that I get. I hope you are clear. Moving on. So, just to give you an idea, a brief again. If there are focus, if there are 6 or more, we will use range concept. First thing that we are going to do is arrange it in ascending order. Second, number of values into 35%, number of values into 65%. If it works out to a whole number, then if it works out to a fraction as we've done, then select the next whole number. So 2.8 ka 3, 5.2 ka 6. Select those two and you will get a range. So select AP in range. So there, select P in range. So there, then for 2.8, third one we selected, for 5.2, sixth one we selected, and accordingly we got a range. If my actual price is in that range, then in that ALP range, then I will say that my actual price is the ALP. If it is not in the range, then I will select the median value. So number of values into 50 by 100, in our case 8 into 50 by 100, which was 4. We select the fourth value, and that is my final answer, final ALP. So now here, if you see, we've covered almost everything. In fraction part we've covered. Now in the next question we'll see what if we get a whole number. If it is a fraction, next select the next number. If it is a whole number, which will always be the case when the data set is 20, calculate. Do your calculation. If your data set is 20, then 20 into 35%, 7. Yes, 20 into 6.5%, 65%, 13. So here, say actual transaction price is 60. So 20 is the number of values into 35%, 7. Since whole number, it is a whole number, add the next and find out the average values. So 7 plus 8 is what you will find, and find the average for that. So here, because it is a whole number, so we choose 62. Plus we choose the next and we take an average of this. 20 into 65%, 13 we choose this, 14 we choose this, and we take an average of this. I hope I am clear. We get a range of 63.5 to 77. Does 60 fall in this? My answer is no. I will find the median. Median again is a whole number. 10 plus 11, the next, divide by 2, and finally I will get 71 as my ALP. So if it is a whole number, take the next, find the average values from the data set. If it is a fraction, just take the next and the value for that. I hope I am clear. So again, we will still have a quick recap. 6 or more range concept, expected 8 mark question can come from this concept, because it is asked in RTP as well. But then again, you have a gut feeling that जो एकदम expected होता है, probably वो नहीं पूछता है institute. You never know. Let's be prepared. 8 to 10 mark is what they can ask, and it's a bonus if we understand it properly. Range concept, 6 or more. Arrange in ascending order, done. Number of values into 35%, number of values into 65%, done. Two things, either we will get a whole number or a fraction. If we get a whole number, then that whole number plus next whole number, दोनों का value लेने का, divide by 2. Once we get that for 35% and for 65%, we will get a range. We will see whether actual price is in that range. If yes, that becomes our ALP. If no, we will find the median, and that median finally becomes my ALP. Second, if the 35% and 65% are fractions, select the next whole number, select the value from that, and we will get a range. Once we get that range, we will check with our actual price. If it falls in the range, we are through. Actual price is your ALP. If not, we will find the median. Median is into 50%. Then whatever value that we get through 50%. Again, here in median also you can get two things. Either whole number or fraction. If it is fraction, next number. If it is whole number, then that number plus the next number divide by 2. Whatever answer that we get from the table, you will get your ALP accordingly. This summarizes your range concept. Please understand it properly. In case of any issues or queries, feel free to get back to me. Thank you. Alright, next in line, some amendments from the chapter TDS. Very, very important from exam point of view. See, TDS, two things. One, it is very important from the case laws point of view as well. And obviously the provisions that are there. So expect a 6 to 8 mark question in all covering TDS. If you ask me, TDS, non-resident taxation, 115C to 115I, transfer pricing, PGBP, capital gain will form a major part of your the paper that you are going to appear. Now, coming quickly to the provision, section 192(2)D, salaries is the chapter. So here, person responsible for paying any income under the head salary. So now what happens is, I'll tell you, there is an employer-employee relationship in the context of salaries. I was an employee with a multinational company when I cleared my chartered accountancy examination, joined a company. So now what happens is, as a salaried employee, there are a lot of perks and benefits, monetary, non-monetary, that I get, and I also get some deductions and benefits. Suppose there is a 15,000 medical benefit that I am getting. That I will obviously get only if I am able to produce the medical certificate or related documents. Suppose there is a leave travel concession that I take. So I should be able to show the journey that I am taking through air, through rail. I should have sufficient vouchers so that I can claim the benefit from the income tax department. So in such cases, the production of evidence for section 80C. So whether you invested in section 80C, what is the amount, all of that. So your person responsible for paying any income under the head salaries is now responsible to obtain the proof or evidence for any related deduction that the employee is going to take. Previously, it was not, the onus was not cast on the employer to obtain the evidences, but now with this provision 2D and FA 2015 amendment, the person responsible for paying any income under the head salary. So if I am an employer and I am paying any income in the form of salaries to my employee, I have to obtain proof or evidence from my employee in order to cross-confirm the benefit that he is going to take. So this is 192(2)D of salaries. Next in line, 192A, TDS on premature taxable withdrawal from EPF. Again, I'll explain. So again, you are a salary employee. there is an employer-employee relationship. So suppose I am an employee, I have an employer, I work for 4 years and then I join some other company. Now for the 4 years that I have worked, obviously I was getting salary, but it was after a certain part being contributed to provident fund, say to a recognized provident fund. So 4 years I have worked, 4 years provident fund amount that I have in the recognized provident fund. Now I have two options when I am leaving the company and joining another company. One, I can transfer it with my new company and the account will go on with the trustees that I have. So what I'll do is I'll just inform the trustees that I'm changing the company directly. Again, my new company will transfer the amount there. Second is I will withdraw the amount that is lying in the employee provident fund. If I withdraw that amount, then in that case I am liable to pay tax because it is before completion of 5 years. I told you it's just 4 years that I have completed. So now voluntary withdrawal before continuous 5 years of service. So I am not continuously serving in the company for 5 years, and before that I am withdrawing the money. In such case it is liable to taxation, and if it is liable to taxation, TDS will have to be deducted by the trustee of that EPF, and he will assume that it is not a recognized provident, it is the unrecognized provident, and accordingly provident fund, and accordingly the income will be liable to TDS. So TDS will be liable at the rate 10% of total income. In such case will be employer contribution. So employer has contributed for 4 years plus interest on employer and employee contribution. See, there are 4 aspects here: employer contribution, employee contribution, interest on employer contribution, interest on employee contribution. In case of employer contribution, what happens is that full amount will be liable to tax. In case of employee contribution, it will not be liable, because in which case it's a post-tax figure. So I will not pay tax on something on which I have already taken care of in my previous year's assessments. Interest on employer and employee contribution is again additional thing that I am going to get, so that will also be liable to tax, and in all such cases TDS now becomes applicable. The only exceptions being that if I retire on account of ill health, or if there is a discontinuance of business, in such case if there is a premature withdrawal, then the tax aspect will not be there and I will be saved from the clutches of TDS. Other than that, the trustee, the employee provident fund, the owners of them are responsible, and they have to ensure that TDS at the rate 10% of total income is deducted. Threshold limit rupees 30,000. So the total year, if it exceeds 30,000, then TDS will be deducted at the rate of 10%. Moving on. Then comes section 194A. So 1, 2, 3, 4. 4 amendments through section 194A. Let's focus on each of them one by one. Cooperative banks to deduct tax at source on interest on time deposits credited or paid to its members. Previously the word was, if cooperative society pay any interest to their members, it is considered that there is a concept of mutuality and accordingly no TDS will be deducted. But cooperative society now, they have removed the word cooperative bank. So it is cooperative society excluding cooperative banks. So now if cooperative banks are paying any interest on loan or on savings to the members, so suppose if I am a member of a cooperative bank, I have a term deposit with that cooperative bank, then I will get interest from that cooperative bank, and that interest will be liable to TDS. Again, threshold limit being rupees 10,000. So any interest above 10,000 will be liable to TDS. Moving on, TDS on interest on recurring deposits. Recurring deposits so far were outside the ambit of TDS. Now they've included the word recurring deposits in time deposits. So previously there were only time deposits, which now includes recurring deposits as well, threshold limit being rupees 10,000. Moving on, next is TDS on interest on compensation by MACT, Motor Accident Claims Tribunal. What happens is, suppose if there is a accident and you go to the insurance company and ask for insurance, it is very much possible that they may deny the claim. Then the case will go to higher authority. So they are say Motor Accident Claims Tribunal. So we go to the claims tribunal. In such cases, there is a requirement by the claims tribunal that the insurance company has to deposit the claims amount with the bank, right? So that claim amount is deposited with the bank. Whoever wins the case will take the amount. So suppose if I and there is an insurance company, and between us the insurance company has kept the insurance claim amount with the bank. If I win the case, I will get the claim amount. If the insurance company wins the case, insurance company will get the claim amount. Fair enough. But what about the interest? What about the interest on that deposit? So in order to clarify, they have introduced this, that if the interest amount on the deposit lying with the bank in relation to Motor Accident Claim Tribunal is more than 50,000, then it will be liable to TDS only at the time of payment. Why? Because the interest is being accrued on a regular basis, but we do not know that interest belongs to the owner or to the insurance company, right? So this provision specifically states that TDS will be deducted only at the time of payment, because it is still in no man's land. Whoever wins the case will take away the interest. So that is the reason the word specified here is at the time of payment. Moving on, threshold limit of 10,000 for core banking solutions. There's a question in your practice manual as well relating to this core banking solutions. What happens is, suppose there's a Bank of Baroda. You have an account with Bank of Baroda branch Borivali. You have a account with Bank of Baroda branch Andheri. You have a Bank of Baroda account with Bank of Baroda branch Chennai. So these are the three bank accounts that you have with Bank of Baroda. Previously, every bank used to look into their own, at branch level, they used to look at the interest payment. So Andheri branch, if there is a deposit of rupees, say for example 1 lakh, and say 10%, 11% is the rate of interest, then 11,000 exceeding 10,000 we will deduct tax. Suppose if this is 9%, then in that case the interest amount will be 9,000. I have one more account with my Chennai branch, which is again 1 lakh, which is again 9%. So 9,000 is the interest that I am going to get. No TDS. No TDS. Why? Because at individual level the banks have to see. At individual branch levels the branch have to see whether TDS is to be deducted. Now with core banking solutions, everything, the data is centralized, so to say. So with that, this total will be accumulated, and the 18,000 is the total amount which will be seen to determine whether it exceeds 10,000 or as the case may be for the threshold. So threshold limit 10,000 is exceeded, because now both of them will be added on account of core banking solutions. So that is how it works. So here there will be a totality of all the branches that you have invested in of the same bank, and accordingly your TDS amount, the threshold limit will be calculated. Moving on, section 194C for payment to contractors. Specifically, this amendment is in relation to transport carriage, wherein they are receiving transport charges. So if there is a payment of transport charges to the transport carriage, and the transport carriage is in the business of plying, hiring or leasing good carriages, owes 10 or less goods carriages at any time during the previous year and furnishes PAN, then in that case no TDS will be deducted on the payment relating to transport charges. So a very welcome amendment for the transport carriage operators here. But again, all of these three provisions have to be satisfied. If you refer section 44 AE, there is a link wherein all of this is there, where the 7,500 per truck per month is the amount of income for these transport carriage owners. So here in this case 194C will not be applicable and the transport charges will not be liable to any amount of TDS. So these are the major amendments as far as TDS are concerned. Again, I use the word majors. There are others. I will still suggest you refer current RTP, refer last exams RTP, and whatever questions relating, case laws relating to TDS are there, please refer them. They are very, very important. Thank you. Alright, so now here we end off. There are some more amendments relating to capital gains, MAT, and some other assessment procedures and other chapters, which probably will be uploaded in my next video lecture. Thank you.